welcome to our YouTube channel. We are now going to talk a little bit about Double Materiality Assessments, or as we often refer to it, DMAs. So my name is Mia Holmsen. If we haven't met yet, I'm the CEO and co-founder of YouSustain, and we do a lot of sustainability reporting, and we teach you how to do it. So double materiality assessments is essentially one of the coolest things that I do in my job as a sustainability consultant. And what it really is that it is a really core concept when it comes to many different reporting frameworks and directives and etc. So you have maybe heard about the Corporate Sustainability Reporting Directive from the European Union, for example. Double materiality is an extremely core concept here. Reason being is that when we talk about sustainability reporting, it can be anything from greenhouse gases, it can be substances of concern like pollution, you can do water, you can do anti-corruption, you can do human rights, you can do value chain due diligence. It's a lot of stuff, and not everything is relevant for every single company in the context of corporate sustainability reporting. So when we talk about double materiality, we essentially talk about how do we figure out what is the most important things for us as a company to report on. This is a very core process to kind of like limit the scope of reporting to what is actually important. So, double materiality mean that we look at impact both ways. So both we look at the impact of, so how does my company affect external factors such as the environment or human rights, etc. But we also need to look at the other way around. So how is the world affecting us as a company? Because our company does not exist in a vacuum. You know, we are connected to everything around us, and there are many things that are sustainability related that can affect our companies. So when we do a double materiality assessment, this is essentially what we do. We look at the inward impact and we look at the outward impact, and then we essentially calculate and figure out what is the most important things for us to take into consideration. So essentially the aim is to end up with this matrix. So here we can see that on the bottom here, we have what we call the impact materiality. So that is the inward out impact. So for example, greenhouse gas emissions, how much impact do we as a company have on external factors? That is the impact materiality. And then we have the financial materiality. So that is the outward in, because here we're essentially looking at how much money do we stand to gain or lose because of sustainability related matters. And as you can see, the line here is curved. And that is because if something is impact material enough, so we have enough impact outward, that should be reported on, even if it's not that financially material. And the same with financial. So if it scores really high on this axis here, but it's not scoring so high on the impact materiality, we might still report on it. So anything that ends up on the outside here, so these green points, these will be our material topics. Essentially what we call them, or sustainability topics. So the things that are material for us as a company to report on, well, the ones who have ended up here, they're not significantly impactful when it comes to either, impact materiality or financial materiality, so we don't have to report on it. And of course, we need to have a very thorough methodology here, and that this also has to be described. For example, when this process needs to go into auditing, for example, for verification of our sustainability statement. But this is in essence what it really is. So what this really comes from is that materiality isn't really a new concept. It has been around for quite some time. So some of you might have heard about the GRI, or the Global Reporting Initiative. So they really started on the impact materiality methodology way back when. I think they started in the 1990s. So they've been around for a while, and they have honed the methodology of how should we actually calculate impact as it pertains to, how much impact do we as a company have outward. So that is kind of what has defined the methodology behind the impact axis of the one that we looked at here. And then we have other frameworks, such as the SASB framework. It has been used for quite some time in the US, for example, but they are following the financial materiality to see what is important for reporting. And as you can imagine, if you only use one or the other, you don't really get the full picture of what is important. So that is why double materiality has become a thing, really, so that we can both look at the outward in and the inward out, and then together we can then figure out what is the most important things for us to report on. All right, so the goal of a double materiality assessment is to identify material sustainability matters. So we've talked a little bit about that before, but now we're going to look at the actual process that we go through, at least at a fairly high level. So this is what it looks like. So when we are finding out what are our material topics, we follow this structure right here. So first, we have to do a value chain mapping. What that means is essentially that we need to paint a picture of the organization so that we understand its context. So that means that we need to figure out, what does our company look like? Where are we located? What do we do? Like, what does our supply chains look like? Do we have physical products? Where do they come from? What do these streams look like, etc.? And that's kind of what a value chain mapping really is. We first start with our own company, figure out what does this look like, and then we can look a little bit further out and look at, suppliers and vendors and customers and all of that. So we kind of just map it out, and we also need to then map activities and business relationships. So this very much goes hand in hand. Activities essentially just means, what does the company do and what is happening within, the value chains of the company. So let's say that you are producing t-shirts, for example, or you're a t-shirt reseller. Then we have to look at, an activity that we as a company do is that we sell t-shirts. So we take the t-shirts in, we have them in a storage unit, we take it into the shop, and we sell them. Those are activities. So the storage, the selling, etc. But then we have a lot of activities that goes upstream in the value chain. So then we have to look at, how does the t-shirts get to our place? What has happened before that? It has probably been, come from a raw material originally. So from raw material to transportation, to cutting, to dyeing, all of these are activities that goes in here. And then we also have to look at business relationships. So we need to look at what kind of actors are in our space. So is it that we have suppliers? You probably do. Or you maybe have customers. You might have joint venture partners, etc. There we look at, different kinds of stakeholders essentially that are included in our value chain. So we do that first, but in conjunction with that, we also look at dependencies. Dependencies meaning, what is the organization dependent on to operate? So in this context, we have natural resources, social resources, and human resources. So things that, if, for example, there are there's no more timber, that is a natural resource that, for example, IKEA would be quite dependent on. So this is all a part or an extension to the value chain mapping. This is where really we create the groundwork for the continuation of the double materiality analysis. So as you can see here, when we get down in this little spider web of ours, we will first come here, which essentially means that we go from the value chain mapping, we look at the activities, business relationships, find impacts, that will be the impact materiality. The reason that we're doing this first is that we can see here, impacts can be drivers for risks and opportunities. But essentially what we're doing here, it's really important that we do the impacts first. And as we can see, the drivers for impacts are activities and or business relationships. So these can work in conjunction. So here we, for example, look at, so we're doing the t-shirts again. We're looking at, the transportation of our t-shirts from point A to point B, they lead to a negative effect on greenhouse gas emissions, for example. So that can be an impact. And then we write this in a lovely little list, and we have impacts. And here, this could be anything, like the entire ESG spectrum can be covered here. If you, for example, do this in conjunction with a CSRD assessment, so the Corporate Sustainability Reporting Directive, you will see that there are various topics that you should cover. But essentially what you will end up with is a list of impacts. And that goes into the impact materiality. And then we will move on to then the risks and opportunities that constitutes the financial materiality. So as you can see here, risks and opportunities, this essentially means a risk is, a risk for the company to lose money. And then the opportunities is the opportunity for the company to gain money, to, gain some monetary value from it. And this will either come from dependencies. Again, if IKEA don't have timber, that can be a risk because they then don't have the supply of the raw material that they need to produce their goods. That will probably have a non-beneficial impact on their financial statements. And as well, dependency on water, for example. Let's say that we found an opportunity to really improve water quality in the local community where we operate. That can have a positive effect for us because we optimize the water system, for example. We can also gain reputational opportunities, so people like our company better and they might be more willing to spend money on it. So here we can really find some risks and opportunities depending on what we are dependent on. And then on the impact side, again, remember from, let's do the t-shirts again, from the transportation, all that jazz. If we have a lot of really high emissions, for example, it's connected to our value chains and people start noticing, they might not be, if you're a lot worse than your competitors, for example, they might not be, not want to buy from you, essentially. Let's say that, the general population now cares a lot about emissions, and maybe that doesn't give you a good reputation, and therefore that might be a reputational risk that you might want to take into account because it might lose you money. And it could also be things like carbon tax, which is more tangible because carbon gets taxed and it will continue to get taxed more in the future. So for companies who don't get their emissions down, they will have a risk connected to this. And from the impacts as well, you can also lead to opportunities. So let's say that you have a positive impact on, let's say the local population in which you operate. Then you can, for example, create opportunities to gain really great employees. For example, if you set up training programs for the local community, for example, that can lead to great opportunities, and you will have great workers. Let's say, for example. But essentially, these risks and opportunities that comes from dependency on impacts, they feed into the financial materiality, and then we have the double materiality. So as we looked at earlier, everything now needs to go into this matrix, meaning that stuff needs to be scored. So we go more into detail on this in our CSRD and double materiality course that you can find in YouSustain Academy, but I will take you overarchingly through what it is really all about. So an impact can be actual and potential. It can also be negative and positive. And it's really important to take into consideration that it has all of these, there can be all these combinations of things. So an actual impact is an impact that is currently happening. A potential impact is something that might happen. And then a negative impact is, negatively affecting an external factor. And positive would be the opposite way, that it has a positive effect on external factors. And then we actually have a formula for how to calculate this. So when we calculate, for example, a negative potential impact, we look at scale, scope, likelihood, and redeemable character. So the scale essentially means how grave is the impact. So how much does it kind of impact something here, while the scope is how widespread is it. So we have the scale, and then we have the scope, and we have to do a calculation for that. And then we have to look at this constitutes the severity. So scale plus scope is severity. But then we also have to look at the likelihood. Note that we only take likelihood into account when the impact is potential. And that is because if something is an actual impact, the likelihood will always be 100%, so the scoring will be a little bit off. Okay, so now we have the scale and scope, which is the severity and the likelihood, and then we also look at redeemable character, which is how hard or easy is it to fix, essentially. So we have scale plus scope, likelihood, and redeemable character. The methodology here in terms of is it plus, do you add them up or do you times them with each other? It is not set in stone. There is no set methodology for how to do that. So that is kind of up to the organization what makes sense. Very often I just do like this, do pluses for all of these different ones, usually score them between 1 and 5, essentially to see how good or bad they are. Okay, so now we're going to look at the financial materiality assessment. So here, now we have looked at the outward impact. So how is our company affecting external factors? And then we use the scale scope, likelihood, and redeemable character to estimate how grave are our impacts so that we can plot that on our wonderful graph. Now we're looking at the inward impact. So we're looking at how is external factors impacting our company financially, or can impact the company financially in the future. So what we then, yes, so essentially, so this is what we will end up with, because now we have established the impact materiality, right? So now we have established this axis here. So let's say that we, per now, for example, have waste, child labor, and climate change mitigation have ended up over here. Now we need to figure out the financial materiality to complete the picture of what is actually material. So this is the section that we're currently doing, because we have done the whole impact section here, which is great. And now, but we'll look at the dependencies and the impacts to estimate risks and opportunities, which will then end up in the financial materiality section, which will land us with the double materiality in the end. So a risk is a sustainability related issue that could potentially have a negative impact on a company's financial performance, reputations, or operations. So what we then typically look at is that, okay, let's say, for example, this carbon tax. For example, how will a potential carbon tax in the future of, let's say, 25%, okay, that's a bit much. Okay, carbon tax of like 10%, how much could that impact our financial position, financial performance, cash flows, access to capital, or cost of capital? So that is what we look at when we talk risk in this concept and how to estimate it. And then we look at opportunities, a sustainability related issue that could potentially have a positive impact on a company's financial performance, reputations, or operations. And again, financial position, financial performance, cash flows, access to capital, and cost of capital are the aspects that we look at to see how much could we potentially stand to gain. And they are all connected. So the dependencies can lead to opportunities, the dependencies can lead to risks, and the impacts can lead to risks, and the impacts can lead to opportunities. So they're very well connected, and this is usually why this is an assessment that takes some time, because you have to look at a lot of interconnections here. Yes. And when it comes to risks and opportunities, we of course also need to score this so that we can plot it on our wonderful graph. We have the financial impact, so how much does the company stand to lose or win? So then we have done a calculation, for example, to look at how much will this tax increase over the short, medium, and long term. So then we essentially rank it depending on some thresholds that we set. And then we look at, okay, this is a very high financial impact, potentially. But then we also need to look at the likelihood of the risks and opportunities occurring. So then we have to, for example, look at, okay, depending on the geographical location that we are, what is the likelihood of this carbon tax actually being realized? And then depending on the financial impact and the likelihood, we now have the risk score so that it can come in to this format. And then we have our double materiality. So I really hope that you enjoyed that little run through of a double materiality analysis. If you want more of a deep dive in how to actually do this thoroughly and also in compliance with CSRD, I would really recommend checking out our little course on that. And I would also recommend you to join our free community, where we have a lovely bunch of aspiring and current sustainability professionals who kind of just chat and help each other out. And it's just a really lovely community. So click the link over here, I think, or down below. I don't know. Go and check it out. Would love to hear from you. And yeah, see you soon.